If you can't afford to pay for a house, you're likely going to need a mortgage. Before you get a mortgage, it's critical to know how much home you can afford, especially as homes become more expensive. In today's video, I will walk you through to calculate how much loan you can afford in more detail. How to calculate how much house you can afford. Income is the most obvious factor in how much house you can buy. The more you make, the more house you can afford, right? Yes, sort of. It depends on how much of your income is already spoken for through debt payments. You might be making payments on a car loan, credit card, personal loan, or student loan. At a minimum, lenders will total up all the monthly payments you will be making for the next 10 months or longer. Sometimes they will even include debts you're paying for a few months if those payments significantly affect how much monthly mortgage payment you can afford. What if you have a student loan and deferment or forbearance and you're not making payments right now? Many home buyers are surprised to learn that lenders factor your future student loan payment into your monthly debt payments. After all, deferment and forbearance only grant borrowers a short-term reprieve, much shorter than your mortgage term will be. Lenders carry a lot about DTI, which is an abbreviation for debt to income ratio. They don't want you to be overextended and unable to make your mortgage payments. There are two types of DTI, front end and back end. Front end DTI only includes your housing payment. Lenders usually don't want you to spend more than 31 to 36% of your monthly income on principal, interest, property taxes, and insurance. Let's say your total monthly income is $7,000. Your housing payment shouldn't be more than $2,170 to $2,520. Back-end DTI adds your existing debts to your proposed mortgage payment. Lenders want your back-end DTI to be no higher than 43 to 50% depending on the type of mortgage you're applying for and other aspects of your finances, like your credit score and down payment. Let's say your car payment, credit card payment, and student loan payment add up to $1,050 per month. That's 15% of your income. Your proposed housing payment then could be somewhere between 26 and 35% of your income, or $1,820 to $2,450. The ratios mentioned above with regard to your DTI are often summarized as the 28-36 rule, meaning your mortgage payment shouldn't be more than 28% of your gross monthly income and your total debt payment shouldn't exceed 36% of your income. Many lenders use this ratio to determine if you can afford a conventional home loan without putting a strain on your finances or causing you to go into default. The 28-36 rule also protects borrowers as much as it protects lenders, as you are less likely to lose your home to foreclosure by overspending on a home. While 43% is the highest DTI that borrowers can typically have and still qualify for a conventional mortgage, most lenders prefer borrowers with a back-end ratio of 36% or lower. The bigger your down payment, the more house you can afford. Once you put down 20%, you won't have to pay for mortgage insurance. That frees up more cash to put toward principal and interest. The higher your credit score, the more house you can afford for the same down payment. A higher credit score will get you a lower interest rate, and the lower your interest rate, the more you can afford to borrow. So what are other factors that influence how much house you can afford? The first factor is your closing costs. Closing costs, which run about 2% to 5% of the purchase price, will affect how much home you can afford to a greater or lesser extent depending on how you pay for them. If you pay closing costs in cash, if that means you have a smaller down payment, you might not be able to buy as much house. If you need to finance closing costs by adding them to your mortgage principal, you might have to buy a commensurately less expensive house. The best case scenario is getting the seller to pay closing costs without increasing the purchase price. It may be hard to get this concession in a seller's market, but it may be more doable in a buyer's market. The second factor is your property taxes. Check the county assessor's website and local real estate listings to get an accurate idea of the property tax rates in the area where you're buying. Nationwide, rates range from 0.3% to 2.13% of the home's assessed value. Assessed value may be lower than the market value thanks to the homestead exemptions. Third factor is the homeowner's insurance. Homeowner's insurance costs more in places where homeowners file more claims. These tend to be places with more crime or storms. A local insurance agent might be happy to give you an idea about the prices in the area since you could become a future client. If you just want to ballpark it, the national average annual premium for a $250,000 home is about $1,100 per year. The factor 4 is mortgage insurance. Are you putting down less than 20%? Expect to pay mortgage insurance premiums for at least a few years. They will cost 0.17% to 1.86% per year per $100,000 you borrow, or $35 to $372 per month on a $250,000 loan. If you are getting a conventional loan with less than 20% down and will have to pay private mortgage insurance, try to minimize this expense. The larger your down payment and the better your credit score, lower will be your mortgage insurance rate and the fewer years you will have to pay for it. Factor 5 is flood insurance. Some homes are in special flood hazard area. This means you will probably be required to buy flood insurance. Other homes are in locations where lender will require you to buy flood insurance. However, you might want to purchase it anyway after investigating the area's flood risks. You can get a flood insurance quote from the National Flood Insurance Program, but private insurers may be able to offer a better deal. Factor number 6 is homeowners association fees. Realtor.com says a typical homeowner association fees is $200 to $300 a month. Fees depend on how many amenities the community has, how many services it requires, and how much upkeep it needs. Factor 7 is home maintenance. Home maintenance will cost money, and the larger and the older the home is, the more upkeep you'll have to budget for. In a shared building, the homeowner association might take care of most maintenance. But if you're buying a house, you'll need to set aside money each month for the new roof you'll need one day, the fresh paint on the exterior, the air conditioner repairs, and all other expenses of home ownership. Budget 1% to 4% of your home value each year for home maintenance. You might not spend this amount each year, but you will spend it eventually. Factor 8 is utilities. You will also need to estimate your future home's utility bills for electricity, gas, trash, and water. You might not be paying for all of these expenses where you live now, or you might be paying less for them because you are in a smaller place than your future home will be. To get an idea of the cost, ask people who already live in the area where you want to buy. Factor number 9 is living expenses. Now factor in your monthly expenses: gas, car insurance, health insurance, groceries, entertainment, pet stuff, kid stuff, retirement contributions, emergency savings, travel, streaming services, and cell phone service. Lenders won't consider these costs when they decide how much to lend you. You need to consider them to know what you can actually afford. Factor number 10, cash reserves. Loan requirements for cash reserves usually range from 0 to 6 months. But even if your lender allows it, exhausting your savings on a down payment, moving expenses, and fixing up your new place is a tempting fate. You will often hear that you should have 3 to 6 months worth of living expenses saved to cover emergencies. As a homeowner, you would be wise to have 6 months to 2 years worth of living expenses saved. You never know when a global pandemic might wreak havoc on your ability to earn a living and pay for your home. How the loan you choose can affect your affordability. The loan you choose can also affect how much home you can afford. In case of an FHA loan, you will have the added expense of upfront mortgage insurance and monthly mortgage insurance premium. In VA loan, you won't have to put anything down and you won't have to pay for mortgage insurance, but you will have to pay a funding fee. In a conventional loan, if you put down less than 20%, private mortgage insurance will take up part of your monthly budget. In USDA loan, both the upfront fee and the annual fee will detract from how much home you can afford. What to do if you want more home than you can afford? We all want more home than we can afford. The real question is, what are you willing to settle for? A good answer would be a home that you won't regret buying, and one that won't have you wanting to upgrade in a few years. As much as mortgage brokers and real estate agents will love the extra commissions, getting a mortgage twice and moving twice will cost you a lot of time and money. The National Association of Realtors found that these were the most common financial sacrifices home buyers made to afford a home. Cut spending on entertainment, cut spending on clothes, cancelled vacation plans, paid minimum payments on bills, earned extra income through a second job, sold a vehicle, or decided not to purchase a vehicle. These are all solid choices except for making only minimum payments on a bill. Having less debt can improve your credit score and increase your monthly cash flow. Both of these will increase how much home you can afford. They will also decrease how much interest you pay on those debts. Should you buy a home now or wait? There's never a perfect time to buy a home or a perfect home to buy, so you have to ask yourself if the benefits of buying now outweighs the drawbacks. Here are some indications that now is a good enough time to buy. You can comfortably afford the mortgage payment, homeowners insurance, and property taxes. Also afford mortgage insurance and homeowners association dues if they apply to your situation. You don't have any reason to think you're going to lose your income. You don't have any reason to think your expenses are about to skyrocket. You think you'll be able to live in the same place for at least 5 years. Your savings won't be decimated after your down payment, closing costs, and moving expenses. You have the time, expertise, or money to deal with home maintenance and repairs. Here are some indications that you might want to wait. Even though you have gotten approved for a mortgage, the monthly expenses combined with your other expenses leave no wiggle room in your budget. Your co-workers are murmuring about layoffs. You have tens of thousands of dollars in consumer debt. You're not in a drastic life-changing situation. You have less than 3 months worth of emergency savings. Can't handle any additional responsibilities right now. Remember the points we discussed today if you are considering buying a home. And subscribe to our channel so that you won't miss any of our videos on personal finance.